Most investors think index funds and ETFs are essentially the same thing. They aren't. In fact, 99% of investors are ignoring a structural detail that could cost them tens of thousands in taxes and slippage over a 30-year horizon. If you're managing a high net worth portfolio, close enough isn't a strategy. It's a leak. We've spent hundreds of hours analyzing the internal mechanics of the world's largest asset managers. We don't care about the marketing brochures, we care about the math. Today, we're pitting the titans against each other, Vanguard versus BlackRock. We aren't just comparing expense ratios. We're diving into tax efficiency, liquidity traps, and the hidden structural advantages of mutual funds versus ETFs. By the end of this video, you'll know exactly which structure maximizes long-term returns for your specific wealth bracket and how to optimize your holdings for 2026 and beyond. Most investors think they've solved the puzzle. You've heard it 1,000 times, just buy the index. Whether it's a mutual fund or an ETF, as long as it tracks the S&P 500, you're winning, right? Wrong. For the average person with a few $1,000s, the difference is negligible. But when you're scaling toward a high net worth portfolio, negligible becomes expensive. We're talking about structural friction, tax drag, tracking errors, the invisible gaps in how shares are created and redeemed. If you're managing $10,000, these differences are pennies. But when you're managing $500,000, $1 million or more, those pennies transform into five-figure mistakes. Most people just blindly trust the brand. They pick Vanguard or BlackRock without understanding the actual vehicle they're using. You aren't just choosing a company, you're choosing a tax structure. And if you've picked the wrong one for your specific bracket, you are essentially paying a convenience tax to the government and the fund manager every single year. You're leaving money on the table not because of market volatility, but because of a structural flaw in your portfolio. Here is the truth 99% of investors miss. The underlying assets in a Vanguard index fund and a BlackRock ETF are often identical. You're buying the same companies, the same dividends, the same growth. But the wrapper, the legal structure, changes everything when you're managing a high net worth portfolio. If you want to maximize long-term returns, you have to stop looking at the ticker and start looking at the tax drag. Let's break down the ETF structure first. BlackRock perfected the ETF. These trade like stocks. You buy them throughout the day. But the real magic is the in-kind redemption process. When investors sell an ETF, the fund doesn't usually have to sell internal holdings for cash. This means fewer taxable capital gains distributions for you. For $1 million portfolio and a taxable account, this efficiency is the difference between keeping your gains or handing them to the IRS. Now, let's look at the traditional index mutual fund. This is Vanguard's legacy. You don't trade these midday. You get the price at the closing bell. To some, that feels slow. To a professional investor, it's a feature, not a bug. Mutual funds allow for true automation. You can set a fixed dollar amount, say $5,000 a month, to hit your account automatically. ETFs usually require manual trades or specific broker tools. This removes the emotional gap. You stop checking the price and start building wealth on autopilot. So, which one actually maximizes returns? If you're investing inside a 401k or an IRA, the structure is irrelevant. Taxes are deferred. Go with whatever allows you to automate. But for your taxable brokerage account, the ETF wins. The tax efficiency of the BlackRock structure prevents the leakage that happens in mutual funds during heavy redemption periods. However, there is a Vanguard secret you need to know. Vanguard holds a unique patent that allows some of their mutual funds to operate as a share class of their ETFs. This gives you the tax efficiency of an ETF with the automation of a mutual fund. It is the ultimate portfolio optimization hack. If you're using interactive brokers or Fidelity, you have the flexibility to mix both. Use ETFs for your core taxable holdings to kill the tax drag, and use index funds in your retirement accounts to kill the temptation to trade. Knowing the theory is one thing. Executing the strategy is another. If you're looking for a platform that handles both high-yield ETFs and traditional index funds with zero friction, I highly recommend Fidelity or Interactive Brokers. Check the links in the description to get started. So who actually wins? For the high net worth investor, it's not about picking one. It's about tax efficiency. Use ETFs for your taxable brokerage, accounts to eliminate unnecessary capital gains distributions. Use Vanguard's index funds in your 401k or IRA to automate your contributions without thinking. This hybrid approach is how you maximize every single cent of your long-term return. If this breakdown helped you optimize your portfolio, hit the like button. And if you want more institutional-grade investing strategies, subscribe and turn on notifications. Your future self will thank you.